Bank of America called it the end of the 60-40, while Goldman Sachs Group said that losses from such portfolios could swell to as much as 10% in 1 month. Welcome to another edition of Wealthy and Wise Wednesdays, my weekly podcast where I share a few words of financial wisdom to help put you back in the driver's seat of your financial future. Today is Wednesday, October 13th. Thanks for joining me. The question today, is the stock market in trouble? I want to share some information with you from an article that was posted in Financial Advisor magazine. And the title of the article is Bank Analysts Warn that the 60-40 portfolios could be battered by inflation. Now, the 60-40 portfolio is a common portfolio that is 60% stocks, 40% bonds, where you're really weighing risk. You have a good portion of that portfolio in growth stocks, but 40% in bonds and fixed income to diversify risk and to give your portfolio balance and to create income. Now, before we get into the article, what I'd like you to do is I'd like you to, number one, follow this channel and subscribe to my content. If you're somebody who is interested in improving your financial education, improving financial literacy so you can make better decisions in your life when it comes to finances, there's no better channel to follow than Sneller Financial on YouTube or over at my TikTok channel. You can also connect with me, Sneller Financial, on Facebook or LinkedIn, and I've even got an Instagram page as well. So definitely follow that channel for more educational content like this. And secondly, if you find this information helpful, make sure that you share this information so your friends, so your family, so the people who are important in your life, so they get exposed to this kind of information, so they can also kind of wake up to the things that are happening around us, so they can make better decisions in their lives as well. So with that said, let's get into it. So recently, it's almost been like a synchronized sell-off in equities and treasuries. And this could be, some analysts believe it could be just the beginning for what's to come for the 60-40 portfolio, that stock and bond strategy. And there is a growing chorus of Wall Street strategists and analysts who are warning about this. So for example, Bank of America called it the end of the 60-40, while Goldman Sachs Group said that losses from such portfolios could swell to as much as 10% in 1 month. Now, there are similar alarms also ringing at Deutsche Bank AG, where their strategists, including the popular Jim Reed, he said that a shift in the stock and bond relationship may force money managers to adjust their thinking. Now, underpinning all of these warnings is an economy that's now facing mounting inflationary pressures after years of battling against the opposite, after years of battling against deflationary pressures. Now, during the last 2 decades, subdued growth boosted the allure of the 60-40 strategy, one that's built on a negative stock to bond correlation where one serves as a buffer for the other. But now, with inflation fears raging, the worry is that the Federal Reserve will seek to slow down the economy by raising interest rates. And rising interest rates will spell trouble for both stocks and bonds. Now, just last month in September, that offered us a taste of the pain, didn't it? Because what we saw, a Bloomberg model tracking the portfolio of 60% stocks, 40% bonds, that saw the worst monthly drop since the beginning of the coronavirus pandemic in March of 2020. Now, Jim Reed, this is what he writes. I want to read it to you. Obviously, for this relationship to reverse, we need to be in a sustainably higher inflation era. There is every chance we are in one, and if so, a lot of the relationships that have prevailed in the average person's investment career could change. Look, the stakes couldn't be higher. A sustained shift in the bond-stock relationship would unsettle trillions of dollars that are managed at-risk parity funds balanced mutual funds, and pension funds that follow this framework of the 60-40 asset allocation. To be sure, the death of the 60-40 portfolio, it's been pronounced before, only to be proven wrong, or at least proven premature. Bloomberg's model has climbed all but 1 year since the 2008 global financial crisis. And despite the recent market turmoil, it's also up 9%. Now, over at Goldman Sachs, strategists including Christian Mueller-Glissman said that a growing dominance of technology shares means the S&P 500 has become a much longer duration asset where the present value of future earnings is more sensitive to moves in interest rates. So basically that means rates volatility would spill over to equities, leading to a larger risk contribution from bonds into balanced portfolios. Now, by Goldman's calculation, a measure of the 60-40 portfolios has dropped 4% in just the last month. Only 5 times since the year 2000 has the gauge suffered a drawdown of 10% over a month's period, including the last one that occurred during the COVID outbreak. Now, the Goldman team, listen to this, the Goldman team advised investors to consider using options to hedge protection against potential losses. One recommended trade is to sell calls on the S&P 500 to buy puts on the iShares 20-year Treasury bond, the Treasury bond ETF. They're doing that as a way to reduce the elevated duration and the rate shock risk embedded in these balanced portfolios. So as we kind of come to the conclusion of today's discussion, again, several bank analysts warning that the 60-40 portfolio could be battered by this rising inflation. Over at Bank of America, strategists, including Jared Woodard, touts 2 trades in anticipation of a secular rise in interest rates. One favors fixed income that's valued on credit risk, such as high-yield corporate bonds and floating rate loans, over those with high rate risks such as treasuries. The second that he's recommending avoids mature equity leaders such as tech megacaps and buys new economy innovators that can benefit most from automation and capital spending to blunt the effects of this inflation. And let me end this with a quote. For the longer term, even if a major rates shock is unlikely, asset allocators may want to consider 2 big changes for a gradual trend higher in inflation and in interest rates, Woodard wrote in a client note. For a steady rise in inflation, buy tech, not just tech, as higher wages spur more capex and productivity in other sectors. So there you have it, folks. Bank analysts from Bank of America to Goldman Sachs, from Deutsche Bank, warning that the 60-40 portfolio could be battered by inflation. Now, what does this mean for you? Now, when we're talking about this and I'm reviewing this, remember that what we're talking about here is for financial education. This is from an article written by Emily Graffio, I think is how you say her name, over at Financial Advisor Magazine. This is not to be meant or construed as personalized investment advice. But more and more people that I talk to are worried about the turbulence in the market. Now, if you are in the accumulation stage of your life, it could actually be a good thing for you. It could provide some opportunities to buy assets at lower prices. But that's only going to work if you have access to capital, if you have safe, liquid money that you can access to make purchases during downturns. Conversely, if you're in the retirement phase of your life or in the distribution phase of your life, or if you'll be transitioning here in the next couple of years, you may want to look at taking some of your profits off the table and locking those profits in by putting them into vehicles that give you complete downside protection. I'm talking about things like maybe it's a fixed index annuity, something that will give you complete downside protection in the down years, but will allow you to participate in the upward trajectory of a market index in the good years. If you're getting ready for retirement, or if you're retired, this is the time that you really can't afford to take a big death hit, so to speak. You really can't afford to mess these things up. So for more information like this, again, follow me on social media, my YouTube channel, over at TikTok. I'm on Instagram, Facebook, and LinkedIn. Again, this is about financial education. This is about improving your literacy so you can make informed decisions that are going to be in your best interest. And if you would like an advisor to help manage your savings, your investments, and your retirement program, I can help you do that. All you have to do is reach out to me at ronald.sneller@snellerfinancial.com or send me a message on any of the aforementioned social media sites. Well, that's going to wrap it up for today. And that's my rant. As always, thanks for listening.